Report. What if the economy you thought was stabilizing is actually sending out alarm signals right now? Today, March 16, 2026, the United States is dealing with a combination of economic pressures that experts are watching very closely. And every single American family is going to feel the impact. Let's walk through the real numbers from real government sources so you can see exactly what is happening. Let's start with inflation. According to the U.S. Bureau of Labor Statistics, the Consumer Price Index rose 2.4% year-over-year in February 2026. That number might sound manageable on its own, but here is the important context. The Federal Reserve's target is 2%, and inflation has been sitting above that target for a long time now. Again, according to the Bureau of Labor Statistics, food prices alone rose 3.1% over the past year, and shelter costs are up 3%. Critically, this February inflation report was collected before the most recent oil price shock hit, meaning the next CPI report, due on April 10th, is expected to look significantly worse. Now let's talk about oil, because this is where things get serious. According to the U.S. Energy Information Administration, at the start of 2026, Brent crude oil was trading around $63 per barrel. As of this week, it has surged to over $103 per barrel, a rise of approximately 50% in just over 2 months. The Energy Information Administration directly links this spike to the conflict in the Middle East, which has effectively disrupted the Strait of Hormuz, a critical waterway that, according to the EIA, handles roughly 20% of global oil demand. Some analysts at JP Morgan are warning that if the conflict drags on with damage to energy infrastructure, we could see oil hit $200 a barrel, which would push U.S. gasoline prices toward $5 per gallon or higher. Right now, Americans are already seeing fuel costs climbing sharply week by week. Now, let's look at the job market, because the picture here is equally concerning. According to the Bureau of Labor Statistics' February 2026 jobs report, 92,000 jobs were lost last month, far worse than the forecast of 50,000 jobs gained. This was the third time in 5 months that payrolls actually declined. According to the same Bureau of Labor Statistics report, the unemployment rate now stands at 4.4%, up from 4.3% in January, and moving closer to November's recent high of 4.5%. There are currently 7.57 million unemployed Americans. The labor force participation rate, also tracked by the Bureau of Labor Statistics, has dropped to 62%, its lowest level since December 2021. Meaning more and more people have simply stopped looking for work altogether, which is not a sign of a healthy labor market. Federal government employment has shed 330,000 jobs, or 11% of its total workforce, since October 2024. And now for interest rates. According to the Federal Reserve Board, after cutting rates 3 consecutive times in 2025, the Fed currently holds its benchmark interest rate at 3.5% to 3.75%, where it has been kept since January 28, 2026. The Federal Reserve's own December 2025 projections pointed toward bringing rates down to around 3% by the end of 2026. But with oil prices now surging and inflation risks rising again, according to the CME Group FedWatch tool, which tracks market expectations for Fed decisions, markets are now pricing in the next rate cut as late as September 2026. That means borrowing will remain expensive for a long time yet. So what does all of this mean when it actually lands in your life? According to the Bureau of Labor Statistics, your paycheck buys less than it did 12 months ago. With food up 3.1%, shelter up 3%, and energy costs surging, the real purchasing power of average Americans has been quietly shrinking, even while wages have failed to keep pace. The February jobs report doesn't just tell us people lost jobs. It tells us the economy is not generating enough new opportunities to replace them. If you are thinking about buying a home, the math has gotten harder. According to the Federal Reserve Board, with the benchmark rate sitting near 3.75%, mortgage rates remain elevated, keeping monthly payments high, pushing homeownership further out of reach for millions of families, especially first-time buyers. And if you are in a sector that is sensitive to energy costs, transportation, manufacturing, retail, Food services. Your employer is under real pressure right now, and that pressure will eventually reach employees. So what can you actually do? First, review your budget today with fresh eyes. Food. Prices up over 3% and energy costs rising fast, according to the Bureau of Labor Statistics. The numbers that worked 6 months ago may not work now. Find every non-essential expense and cut it. Second, if you do not have an emergency fund covering 3 to 6 months of expenses, start building one now. Economic volatility. Like this is exactly when that cushion becomes the difference between a difficult month and a genuine financial crisis. Third, if you have a variable rate loan of any kind, now is a serious time to look at locking in a fixed rate before any further adjustments. Fourth, if you drive regularly, be very mindful of your fuel consumption, with Brent crude now near $103 a barrel, according to the U.S. Energy Information Administration. Prices at the pump are going nowhere but up in the near term. Carpooling, consolidating trips, and using public transport where available are practical steps that genuinely add up over a month. Fifth, do not make panicked investment decisions. Markets will likely remain volatile as the Federal Reserve meets this week on March 17th and 18th to make its next policy announcement. What traders do in the short term is driven by emotion. Your strategy should be driven by long-term thinking. And sixth, stay informed. According to the Bureau of Labor Statistics scheduled release calendar. The next CPI inflation report drops on April 10th, and the next jobs report comes April 3rd. These two numbers will tell us a great deal about where this economy is heading in the months ahead.